Welcome to Insights. I'm Eric. Thanks for stopping by today. We're going to talk about corn, soybeans, and wheat. We're going to do a quick review here, talking about the risks that are taking place, not only specifically in terms of what we see in through the evolution of the trade in their markets, but as well as what's taking place behind the scenes in the real world, in the global economy, things that measure liquidity and concepts like that. Everyone who's watching this review, this review is designed to raise some flags to get you to think about what's taking place, to expect the unexpected. We suggest watching the inside. We did a preview in terms of our setup, a written setup that previewed this. The economy and stock report, we talk about the risks, and we specifically talk about them in terms of liquidity measurements. We're suggesting, or at least defining, the invisible hand is defining for us. Liquidity is drying up, yeah, universally across the board. There's all sorts of warnings. We can't really go in and talk about it in such great detail. It would extend this video too long, and people tend to tune out after 10 minutes. You really shouldn't be tuning out here. Why are we concerned about that? All markets are interconnected. Whether we're talking about the stock markets or the bond markets or the grain markets, if you see trouble in one, if the trouble gets bad enough and it starts to spark selling or even buying, you can often, and buying nobody worries about it. It's the selling that people, it's concerned. It can spread over into other avenues. Selling in the bond market, dysfunction or dislocation in the bond market, which the Fed can often try and cover up, or central bankers try and cover up, can spill over into the real world loans that are out there, into the banks, which then can cause problems there. Dominoes start to fall, and all of a sudden a problem in the bond market spills over, and you're looking at lower grain prices across the board, scratching your head, how did we get to that point? And that's just because the global economy, which is not a new concept in this cycle, the global economy has been around for thousands of years. It's completely interconnected. A trouble spot in one area ultimately spreads throughout the globe. And we have to be aware when, at least when the strain is rising. And we're going to point out a couple brief observations. We're not going to go into explaining them. That we have separate reports. And we mentioned the NASDAQ 100 report. We mentioned the economy and stock report, as well as these individual reports here. Corn, soybeans, and wheat have their own reports. We talk about the setup in far more detail. I know that sometimes it gets long-winded, but you have to understand that there's more than just what's taking place in terms of the price action, the three time frames, the daily, the weekly, the monthly trends. There's also energy that takes place, but that is important to an extent. And then you have the broader picture of what's taking place. If you're walking into the forest, it's not just the trees that are around you that define it. It is the entire ecosystem that you're walking through, but it's easy to forget about that. And it's easy just to focus on the animals and things that are within your sight. And that leads to problems, that leads to unexpected outcomes when you focus on just whatever's in front of you rather than behind the scenes. That's why we have a computer. The computer constantly monitors all this stuff. We're looking here at the three markets, corn, soybeans, and wheat, and we're looking through the movement in the three time frames. But there's a lot more going on than what we're seeing. In terms of what we're seeing markets that have been up almost 25, 26 months right here. These are the primary trend counts. BUT, it's BUs for bull, BRs for bear. So these are monthly counts. These are the returns that we're seeing. They look impressive. There's some warnings all over in here. PTD1, PTD2, that's because the primary trends are getting extended. That has everyone worried that we're due for a sell-off based on that alone, but the individual reports talk about how this computer, this matrix, the version that everyone subscribes to, only goes back to 1959. Inside the reports, we extend that into a longer-term matrix, a longer-term analysis where the computer studies trends back into the 1800s. hundreds and hundreds of years. You have to if you want to look at the cycles and understand them. Some of these get shifted around. I'm not going to talk about that specifically. The real risk here is not whether these can continue to go up. I mean, that's something you can learn and study when you track the reports for the individual grain markets. There's more going on here than just the movement through the evolution of the trade and these cycles. I'm going to touch briefly on it here. If we slide down to this part, and this is the matrix that everyone looks at when they subscribe, one of the long-term cycles that we focus on are the Moody quality spreads, which are down here. Again, these are talked about in the economic and stock report and a lot of the reports that we do. And these are starting to rise. So we focus on C1, C2, C3, and C4. And I know this is a gloss over because this is an open review and we don't want to go too long because we want people to start to recognize that there's something more than just the individual price action and the assets that they're tracking. These quality spreads are starting to pick up. Normally they baseline down below zero or zero, and they move in cycles. It just goes up versus down and up. And if you follow the cursor, they move. The trouble starts is when the shorter term cycles and even the longer term cycles, they get above one, they start to approach two. That's the invisible hand's way of saying that there is strain that's developing inside the private sector corporate market. People are running away from junk bonds and they're scrambling into high quality corporate bonds, and they're doing so with acceleration. It is that acceleration that tends to put the system at risk. This is one of numerous measures which you can use to measure liquidity across the board. Again, we talked more about it in the economic report, so I suggest taking a look at this. But this rise here up to 1.75, and we're going to update this again soon if this is expanding even further. It puts pressure on the entire system. Now, the entire system, you say, well, what does that matter? That, well, you have grain trades within that system. So does the stock market. And these are all stock indices, and this is precious metals, and here's the currency markets, and the bond market, and soft grains up here, and then copper is right down below here. They're all assets that are tracked within the matrix, but they're all defined within the global economy. So if liquidity starts to dry up, it threatens the global economy, and the components within the global economy are threatened to varying degrees. Some markets have moved faster than others. Bitcoin and Ethereum down here are going to respond faster than the stock market. One of the other reports that's ongoing is the NASDAQ 100, and it's starting to raise some concerns. We did an update just recently on the NASDAQ 100 report and added it to the special report. Again, these are all things that are inside the website that you can follow, or you can track, or you can participate in with. And I'm not really here to necessarily promote any of that stuff. This is just these are just a general warning. The NASDAQ 100 is one of the sensitive areas. It's one of the areas that if you see down here in the intermarket trends, you see the Dow Industrials, the Russell 2000, the NASDAQ 100, and the S&P 500 is here as well. It used to be the leader to the upside. The Dow Industrial is the leader right now. It's the tallest one. You can talk about it here. The computer tells us what's going on. It's international big money is parking into the stock market. Well, it used to be the NASDAQ 100 is up here, but now it's pinned to the bottom. It's the biggest laggard that's in a market that's going down. That warns us to pay attention to the NASDAQ 100, and that's why the NASDAQ 100 report is so important, because you have to understand where those lines in the sand go. If those lines in the sand fall, those critical reversals, you can easily have a liquidity-driven event. It's an event that's pushing down the NASDAQ 100 due to things of this nature down here, signs of growing strain and growing illiquidity, or liquidity drying up. If the NASDAQ 100 pokes through those reversals, you have a backdrop where you could have intense selling in the stock market. And that usually takes place inside key reversals. We call them air pockets. I don't want to go into too much of this discussion because it's a long-winded one, and it really is discussed in the reports. If you get inside that air pocket, bottom line is you really have a chance for some panic selling that's going to take place. Panic selling within a liquidity strain that we're seeing. This is not extreme to the point. It's growing extreme, and there's other measures other than this that you need to be aware of. if that happens within that, you can have selling that's triggered in the stock market, which is being triggered in the bond market as well. It can spill over to the grain market. And you have to find at this point where the reversals lie in the grain market. We talk about them here and how you get them. We're going to update the individual reports for the grain market specifically to address where the setup is. Some of them have been updated recently. In this case, the leader is corn. It's the leader to the upside. It is the group to watch. You follow the leader. Where goes the leader? There goes the market, or as the leader goes, so does the market go. If corn starts to falter, they're all going to falter. And you have to know where that stands. But considering what's taking into the macro backdrop, what you see in news in terms of what the news is not reporting, the major hit that's taking place in the semiconductor industry, the hit that's pulling American workers from out of China and bringing them back home, those are huge disruptive events. Those events are going to affect the technology stocks, which is the NASDAQ 100. That breaks the ice. The chances of the interconnectivity of markets, the chances of it spreading pick up dramatically. So you have to know where those lines in the sand are, and you have to watch them closely. And even if you're a producer or farmer or anything that just really deals entirely with the grains or the agriculture in general, you've now become a stock trader based on the fact that everything inside the matrix is interconnected. So unfortunately, you're going to have to know where the NASDAQ 100 is, where it lies, what the pressures are, where the energy builds are. That's why we have the report to track it, to help you through it, to talk about what's taking place in the matrix. What takes place in the matrix is what the invisible hand is saying. That's an opinion that's completely separate from social media, from mainstream media, or for whatever. Very few people know how to track this stuff real time, and few people know how to even know when there's a problem. The NASDAQ 100 stands on the doorstep of a fairly sizable air pocket. If it slips into that, you are going to see fairly intense selling. I can't say that that's going to be guaranteed. Nothing is guaranteed here. It's only based on probabilities. And we saw a few things as through Friday's close that were a bit disturbing in terms of not just the price action, but in terms of the energy builds that take place inside the equity markets. So this is the warning. This is the heads up. All grain traders, all grain producers, all grain suppliers, everything else inside, and everything that's related within this industry have been put on notice and are now becoming really stock traders and macro economists that are tracking the invisible hand because of the unique setup that's taking place both globally and domestically. And the fact is, the United States is not an island by itself. There's a reason why that US dollar continues to rally. That's another important report that we've been maintaining. If you're not participating in that one, I would suggest doing so. It's absolutely essential. It is putting people down since 2021. We have flagged that without a doubt. That's not something that's trying to make a narrative for us and saying how good we're doing. It provides us no pleasure to say how well the dollar is doing and why it's doing that, because it's just because we called it. This is not, we don't call anything. The invisible hand calls this stuff and we just follow it. You can follow it too by subscribing to the Matrix and learning to follow flips and knowing when markets are prone to move. A lot of damage can be contained if you stop trading against primary trends, but most people don't know how to consistently define them. The US dollar index is trading higher and it's causing damage, and it's because of a lot of this that's taking place. As liquidity dries up in here and it spills over and markets start to sell off, there's nowhere to park. And I know a lot of people are claiming it's going to be precious metals and crypto, but their time will come. Either their time will come to blow up, or their time to come to offer safe haven will also arrive, but that is not right now. They also follow cycles, and we're going to talk about those. I'm going to do an update to the US dollar index that's going to talk about both gold and the dollar cycles and when we should expect a flight to quality inside the precious metals. It's not something we talked about too much yet, but it's going to need to be addressed. But the fact is as you spread through here and appreciate this conversation that we're having here in terms of, wow, sure, I've never thought that these markets were all connected like this. This is the take-home message. The grain market does not trade in isolation all by itself in a dark room or with 15 screens in front of you focusing on the grain market. If you saw our trading desks here, you'd probably be somewhat surprised by the fact that we don't have 10,000 monitors up. The fact is that the computer does all the work mostly when the markets are closed, and we just open them up and we can look on them even on a single computer that's not even that powerful in terms of what you would think it would be, because the ideas of following primary trends, secondary trends, tertiary trends, and energy builds, they're not that complex. I mean, they're quite novel, but they don't really reflect what most people think you need to understand in order to track this stuff. These concepts are difficult, or only because they're different. That different is something that people will look at this and say, I never thought trends worked in a fractal nature. I never thought there was concepts of energy behind trends that fuel them up and tear them down. These are things that we address, and we're trying to address them here in the corn market, but really for each one we can do that. But what I'm trying to warn people of is that these markets, the corn, grain markets in general, corn, soybeans, and wheat, they're related to the bond market, which is related to the currency markets, which is related to the stock markets, which is related to precious metals and Bitcoin. And you have to understand when the vulnerability exists. And the biggest point of vulnerability is, again, when liquidity starts to dry up, starts to spike, and you have to be aware of it, and you have to know that it could be time for a surprise in the grain markets coming in the coming weeks or even in months. We'll just have to see. This is a conversation that's going to continue on, and it needs to evolve, and it needs to be updated. So consider joining us either through the reports or through the subscription, because if some of these lines in the sand go in what you would think is unseemly, not related markets, when the hell do I have to follow the NASDAQ 100 for? Why do I have to follow the semiconductor stocks? At some point you do, because selling gets more selling and it causes panic. And we have not seen capitulation of real fear yet. There's a chance that that will take place down through into 2023, of which it will take down a lot of people if you're not prepared for it. If you have any comments or questions, let us know. If not, thanks for watching today's open review on the grain market. Take a look at all those reports we talked about, rewatch this if necessary, and really start to consider it might be time to learn something different.